Fiducian is delighted to host this webinar for your benefit and equally excited that you have taken the time today to hear more about the Fiducian Technology Fund. Today, our keynote speaker is Mr. Indy Singh. Now, many of you have met Indy, but I'll briefly share with you that Indy is the founder and executive chairman of Fiducian Group Limited. He's a pioneer of the multi-manager investment process in Australia, and Indy is a Lifetime Award recipient for his contribution to the financial services sector by Money Management. He is also an Order of Australia recipient. Finally, in regards to the Fiducian Technology Fund, and before we get into the facts of the presentation, we are aware of the fund's performance, and it has been exemplary at a time of much uncertainty in financial markets. Despite this fact, our process is often valued by independent financial advisors as more so a source of consistency in the face of clients. However, it is hard not to take note of the one-year performance of the fund, which itself was 32.19%. So without further ado, I will pass on to Indy and members of the investment team.
Well, thanks, Jacob. I hope people can hear what I have to say, and I welcome all of you for joining. We have a minute or two to go, and I think we could wait for a few more people to join in. Okay, well, let's begin, because I know you are all busy, and New Zealand is pretty much an open economy for business, whereas Australia is still struggling to get over this COVID-19 problem, particularly Victoria and Melbourne, where people can't get out of their homes after 8 o'clock at night and can't walk more than 5 kilometers away from their homes, which is very sad. But we'll go ahead, and I'll start the presentation, Investing for the Future. This presentation was supposed to be done by Conrad Burge, who's our head of investments, but unfortunately, Conrad isn't feeling too well, and he's asked me to deliver this presentation. And I'll go to the next slide. What do we mean by technology today? According to the Oxford Dictionary, it's scientific knowledge used in a practical way in industry. And I think Conrad's added this, that he would add that it is to be used to improve the standard of living of the world's people. This was a concept I came up with. In fact, I got this from a group called the Bank Credit Analyst. The brain technologies were the ones that would lead the world into the future. Biotechnology, robotics, artificial intelligence, and nanotechnology, which are the brain technologies. There are also other revolutionary things like the GNR revolution, which is genetics, nanotechnology, and robotics. Now, nanotechnology is not yet, I think, a fully fledged industry, but it could become something that would drive the rest of the world if we can control it and have, importantly, the legislation to control it. And obviously, there's much more. The future of innovation is uncertain, except that it will occur, and it provides the incentive for investment, which holds the key to productivity growth, which in turn holds the key to economic growth, as I will explain further. I go to the next slide. There are three constants: death, taxes, and to me, the third one, technological change. And those of you who might have been kind enough to attend the presentations I did in New Zealand would have heard for the first time that technological change to me is the third constant, and it is going to continue 24/7 and without end. It's reached a platform where it can only propel itself by quantum jumps going forward, and it will take the world with it. So investors who are keen and want to be part of this growth should be in it. And those who aren't, well, I think that's their choice. The next one, Conrad likes to do the performance numbers up front. I usually do them right at the end. But if you can have a look at these performance numbers, the technology fund on selecting super was ranked #1, and this is to 31 July. I think 10 years to August was more than 20. I think it was 21.5% a year for 10 years. And it's the only fund that is ranked #1 every single performance measurement period. The next one, as you can go down the slide, there's many more funds there, but they've usually taken the 3-year ranking to produce the top 10. And if you go down to the one that's #7, for example, the One Answer Pension Fund, or even lower, the West Australian Super Retirement, which is 10th, they're ranked 2nd and 5th and 7th. Over 10 years, the difference between our fund and the one that's ranked 2nd over 10 years is almost 7% per year for 10 years. So it's a phenomenal result, and I think the selection of what's going to lead the world with the brain technologies seems to have proven itself. I'll go to the next slide. Well, this is one of those things that say, yes, Fiducian is ranked #1. But going to the next slide, it's a very powerful performance that you can see, and a powerful slide that shows, importantly, if you look at the various lines, the one that's the brown one at the bottom is the Australian S&P 200 accumulation index, the accumulation one, which brings income into it. And I think New Zealand would be around close, where over the 10 years, it's doubled or a little more than double in value. So 100,000 there in a New Zealand fund or an Australian share fund should be over 200, should be around $200,000 or above in 10 years time. So it's doubled, which isn't bad. At the same time, if you look at the technology fund, it's grown to 700,000. So it's up 7 times. It's ahead of the index, it's ahead of the NASDAQ, and definitely above the S&P 500, which has done well, and definitely above the Australian and New Zealand share markets. So it's a very compelling graph for investors to look at and potentially use for their advantage going forward. Now, those of you who might have heard of the tech wreck, because I know it was over 20 years ago, what happened then was technology was something new. It was coming through. The big IBMs and Apples wasn't even there. It was IBM, and it was, I think, Microsoft. The index, the dark blue line was rocketing up, and the expectations of forward price to earnings for the securities that were on the NASDAQ and the S&P 500 were phenomenal. If you look at the forward price to earnings on the right side, the light blue line, investors were projecting the price to earnings of up to 70 times. And then it all came unstuck when people realized that these projections were too high, that a lot of the stocks there weren't ever going to make any money, and the price to earnings expectations fell, and the index fell from about 600 and something to below 150, almost 70%. And that was awful, because the market in technology, which everyone thought was going to be take the world forward, collapsed by almost 70%, and it brought all other markets down with it. But what they missed was there were some really, really good companies that were going to propel productivity and growth going forward. And as you go forward to 2019-20, you can see the index, which is the left-hand side, has shot up again, well beyond what it was in 99-2000. But at the same time, you can see the forward price to earnings hasn't gone crazy. And the earnings are really a reflection of the companies. Now, the price to earnings has risen a bit, quite a bit over the last year, when people have found that there's really nothing else to invest in with coronavirus except technology. And two of the stocks like Apple and Microsoft have accounted for a large share of this gain. So the price to earnings ratio has gone up, but at 30. However, the earnings are extremely strong. For example, Apple has over 140 or so billion dollars of cash. Google has almost about $80 billion of cash sitting with them in their companies. A lot of it is going into investment in technology, research to come up with the next new thing. So while the index has gone up, the number of stocks in the index have also grown, but the earnings are extremely powerful and the price to earnings relatively is still quite low. If we go to the next slide, you can see there the shaded light blue area are the free cash flow margins. And the free cash flow margins for the tech sector is roughly 18%, whereas for all other sectors in the US stock market, it's only about 6%. So the free cash flow coming from the tech sector is 3 times more than all the other sectors on the indices, which actually justifies that these stocks should have a relatively higher price to earnings multiple than the other stocks. Now, the average of the other stocks is also above 20 in the US, but their earnings, free cash flow, is a third of what the technology sector is producing. So cash being generated in the technology sector is enormous. Revenues are huge and the expansion of their markets is great. Now, this obviously increases the valuation multiple investors are willing to pay. Some stocks have gone very high when their earnings aren't there, but we are choosing those stocks that we see have good earnings and have potential to grow even further. If we go to the next slide, what's important is that a security or a company should grow faster than GDP. Now, if it can grow to nominal GDP, a person or an investor's money put in the market or in a security will at least beat inflation and show that their asset value is growing up and can keep up with inflation. Now, you could see right at the end, around 20, the nominal GDP has tipped down a bit, and so has the technology sector come off, as we have seen over the last, since March last year, after coronavirus hit the world. But it's still well above nominal GDP. So there's GDP growth plus inflation, and the technology sector is growing much, much faster than nominal GDP, in which case those who invest in it will have their assets protected better than growth of inflation and GDP. So it's a compelling reason to be in the sector. Now, is technology expensive? We believe that earnings forecast, the consensus, is still conservative. The price or the market cap, as you know, is only one part of the price to earnings equation. The denominator, which is the earnings forecast, we believe is conservative, and as per the last results that we had of June quarter, earnings results were much ahead of forecast. Why is technology outperforming in terms of earnings? Tech companies are often highly innovative and often the first into new fields. Though they're disruptive technologies, they can expand rapidly from small beginnings. As you know, Apple and Microsoft started in garages. They can offer new solutions to old problems in medicine, in transport, in manufacturing, in defense. And there are a whole range of areas. Everything we do is being driven now by technology. The question was, can technology continue to outperform? We seriously believe it can, because globally, not just in our countries, we demand lifestyle, and productivity improvements. And frankly, the global or the developed economies cannot survive without technology to improve their lifestyle and productivity. Now, besides some large IT companies that I mentioned, particularly Apple and Microsoft, for example, other tech subsectors remain fairly priced and are primed for price increases. So we can see that these companies may have been overpriced because since the coronavirus, people have really been jumping into Apple and Microsoft as the ones that are safe. We believe they have been priced up a bit, but there are other tech subsectors which are fairly priced and will drive the market forward in our view. Now, this was a long, highly worded slide, so we've split it up. For example, global e-commerce since COVID-19 have shot up almost 25% of all sales due to coronavirus, and likely to continue as our habits change, as we buy more online and can find that there are benefits of buying online where things can be returned or can be changed and you can get the right size, shape, color pretty quickly without having to go into the stores and spend time. Now that's another experience, but many people are realizing there are benefits in e-commerce. The next, artificial intelligence. That's the new technology realm that's coming through. Now, what we've approached so far is more machine learning, augmented artificial intelligence, where machines can be used by humans to improve efficiency. So they are now being used into product design, in engineering diagnostics, in robotics, in medicine, in coding of programs. Now that's the really big one that's coming through, and they're called GPTs, generative pre-trained transformers, that actually can learn relationships between words in a text. So there was GPT-3 that's produced by a group called OpenAI that can write technical manuals simply if you tell it what to do. It can write songs. It can even produce financial statements for people who have no accounting skills. And now GPT is used to program other computers and create computer programs. And now some of the results have been pretty ridiculous, but most of the ones that are coming through are unbelievable with accuracy and the speed with which the results are coming out. So watch out for this space. Now, we have these stocks like Apple, Microsoft, Alibaba, Google, and Facebook. They have developed and are developing their own versions of GPT. And they're spending billions of dollars in this research. So look out for this one. And we already have these companies in the portfolio. So if they make a breakthrough, because as we believe that this is going to be a big thing where we will actually start heading towards artificial intelligence when a computer can actually program other computers. And that would be phenomenal for the world. The internet. The internet itself is expanding into many new areas beyond computers and smartphones. Data use, data collection, sorting, and use actually holds the key to understanding markets. Cloud computing, as you know, is growing in importance for many companies and probably be where everyone stores their data. Now, there was the Internet of Things where everything was developed and controlled by an internet. For example, a tractor being used, say, in the Midwest would be connected to the internet, and you could plow the field at night because the computer would control the tractor to go up to a particular point, turn around and plow back again and continue till it finished the field. Just amazing stuff happening even for day-to-day simple use. And cloud computing, as I said, is going to be where most people store their data. Now, we have a portfolio which as you know, is biotechnology and other technology. So the brain, the B part of the brain is biotech. Then the other technologies are artificial intelligence, robotics, and nanotechnology. This was an old slide, which some of you may have seen earlier, but it is showing that normally drug approvals by the FDA in the US were no more than 10 to 20 till biotechnology came on the scene. Today, if you go to 2020, there are more like 150 to 160 biotech-driven drugs that are awaiting approval at the FDA. Normally, as I said, only 10 to 20 a year. Now there could be over 100. And it's phenomenal the kind of stuff that these drugs will do. And they're basically non-invasive. So you just take the tablet rather than like chemotherapy, you have to kill all the good cells and the bad cells and stuff like that. So where would this come through? For example, biotechnology deals with genetic coding and checking on other people's genes. And there are a number of genetic breakthroughs like immuno-oncology for once, which is recognition and elimination of cancer cells. In fact, I remember when I presented in Wellington, there was one of the attendees who came up to me after the presentation and said, Indy, my relative had lung cancer and he started taking these tablets. It was expensive, but within 28 days, the cells started to clear up. And he was trying it out. So there's huge work being done in cancer because it's a genetic defect and the cells that are being mutated will be eliminated and good new cells can grow. The other thing is gene editing, where you can change a person's genetic code. So there are people who have recessive genes for all kinds of illnesses. With this particular coding, you can edit and change a person's genes. And in fact, it used to cost something like $100 million to sequence a gene and to break it down. Today, it's less than $1,000. So you can easily get your genetic makeup coded to find out if you have any recessive genes to protect yourself and your offspring from any problems and ailments going forward. These medications are now being prepared and are developed for treatment of lung disease like cystic fibrosis, where the lungs just don't breathe any air, Alzheimer's, Parkinson's, cardiovascular diseases, and they can also be used and are being used to improve animal health and also agriculture. So it's phenomenal how biotechnology advancements are going ahead. Now, this is a great graph which we got from one of our fund managers, and it was produced early in the piece when I was really thinking about setting up the technology fund. And what this says, if you look at the dark blue shaded line, is the contribution from humanity to our GDP. As you go further, getting close to 2040 or so, it says the contribution from humanity or manpower will be almost zero. And the contribution to GDP growth will probably be almost 100%. And going forward to about 2060, they're saying that GDP growth will be sort of stable at around 1.8, maximum 2%. If you go back to 2014, you'll see it was about 3.5, of which productivity gave about 1%, and humanity gave 1%, and 2% came from productivity growth. Going forward, it's going to be virtually all productivity growth, which must come only from technology. So productivity and IQ led the Industrial Revolution and allowed us to escape the Malthusian trap. Now, the Malthusian trap was that the sons would always be poorer than the fathers because the land could be divided amongst 2 and then amongst 4 and 6, and there was no more land, but people were growing faster than the GDP was growing. And then suddenly the Industrial Revolution came, and you can see from them that population started to explode and also GDP started to go. Because before when we were in the Malthusian trap, GDP growth was barely 1% a year. And then technology came and led us out of it. through agriculture and through other industrial revolution. IQ, they tell us now, for all the developed world, is pretty much starting to stagnate, and the tests are proving that that's the case in Europe. Certainly, only productivity can ensure that per capita income in real terms can grow faster, and it will grow faster than population growth. And therefore, we will continue to escape that Malthusian trap. The answer, obviously, as this chart is showing, these graphs are showing, is technology. Now, here are some of the top 10 positions we have. You can see the first one, Apple. We're underweight. We believe the price has gone too high. As I said before, Apple, Microsoft, possibly Amazon have led the charge for the index and for technology stocks. And people seem to be just piling into them without actually understanding how far and how fast their earnings can grow. And they will grow, there's no doubt about it. It may take a little more time than people are thinking. So the other side of this is that now the Democrats have the lower house in the United States, and they're trying to stop the growth of these big technology companies and saying that they're doing too much and they have too much control on people's lives. So like happened before many years ago when the US government stopped the growth of the likes of the Rockefellers and JP Morgan and others, who actually had to fund the US government and bail them out many, many years ago after the depression and the stock market crash. The government is now trying to rein in the growth and the control and power that these large IT companies have on the world. So there may be a bit of slowdown if they're asked to split up and stuff, but those companies themselves will also continue to grow and grow very fast. So we're underweight Apple. The index is about 13.3% for it. We're just at 9. We don't see any problem, but Apple is going to grow. Amazon also has a big part of the MSCI World IT Index. We're a little underweight that. And you can see that we're also a little underweight Microsoft, almost half of what its valuation suggests to be part of the index. We've taken a run with it, we've grown with them, and now we see that there could be some corrections. Unfortunately, a lot of people without advice are trying to bail into these stocks. And as usually happens, investors who don't take advice, don't take a proper financial advisor, end up going into stocks where there's a herd mentality and then eventually get hurt, unfortunately. We are overweight a number of other stocks like Biotechnology, which are also into semiconductors. Alibaba, which is a great opportunity in China. Salesforce, which is where a lot of people are going in controlling and managing their sales forces and their businesses. And we think Global Payment, which produces technology for most of the credit card companies and other companies that are using the IT wallet to make payments and things, has a great future and a great opportunity. So you can see Salesforce and Workday, which are controlling how financial services perform, and HR software or managing people, they have great potential. So we are significantly overweight there. Visa too, we are overweight, and we believe that Visa will probably take on the likes of the Afterpays and others going forward. With respect to biotechnology, we are seriously underweight Amgen, which is a big biopharmaceutical company, and we are underweight Vertex Pharma, which has risen extremely fast on the index. And we see that it's a good company, but it's too expensive right now. So we've undercut that and underweighted, whereas we underweight some of the other names too, like Seattle Genetics, and you can see Acceleron Pharma. So you can see that we're not afraid to underweight companies where there's a herd mentality pushing it up if we see that the valuation has gone beyond what is reasonable at that time. At a right time, we may increase our exposure. And that's the beauty of having specialist people managing the stocks for you and selecting for you. If you ask me, absolutely, I mean, look at Roche. All of us know Roche. It's a big pharmaceutical company, started in Switzerland, and we're seriously overweight when it's not on the benchmark or not on the NASDAQ. Pfizer, another one that's leading the charge for a vaccine for coronavirus, and AstraZeneca also leading the charge for the coronavirus vaccine with Oxford University. So we are overweight in these companies. If we go to the next slide, the Fiducian Technology Fund in itself, we have one team that's has people in Boston, Singapore, and Tokyo, and with global reach, and including some people in Silicon Valley. So this is for other technologies, which is biotech, robotics, sorry, not biotech, but robotics, artificial intelligence, and nano. And this is where 70% of our exposure currently sits. Biotech is where 30% of our exposure sits. We're still watching that space, and we have exposure to companies, as I mentioned, about the COVID-19 vaccine and others, where we're sitting and waiting, and that result, we believe, has a high probability of coming through, and these companies are likely to really catapult up the ladder, but we have only 30% of exposure because there's more certainty at this time with other technologies. We've also added a third arm to our team, and that is Nordic technology, because a lot of the new technologies come out of the Scandinavian countries and some of the Northern European countries. So we've just included this in our fund. Northern Europe is sort of the Silicon Valley of Europe and has been neglected quite a bit by a lot of people. But it has some, great companies that have tremendous potential. And we have just added this new fund manager to our portfolio. And the money is going in there as I speak and will soon be invested in the stocks that they have selected especially for us. Now, just remember, we own all these securities. We don't invest in any funds as such for this technology fund. And if we don't approve of a fund manager or a team, we just can cancel it on the spot. And we just keep the securities and appoint a new fund manager who can alter the securities, manage the securities, change the portfolio to what we believe is more desirable. So as multi-manager, we appoint other people who are specialists, but we have complete control on if we want to keep them or not, and we have control because we own all the securities ourselves. So really, in summary, we've been going for about half an hour. I think there may be questions. In summary, technology is the pathway to the innovative future. Tech companies are to be found in almost all parts of the economy, right from your refrigerator to your car, to the speed control in automobile parts, to defense. Almost every part of the economy, tech companies are now in them. They usually have a first mover advantage in many fields. As you can see, we started years ago with the telephone and then came out to the dial tone, and you had to dial the numbers. Either you could push buttons or dial them, and now you have something like this, a mobile phone, which is hardly a phone. You can watch movies, you can send messages, you can read your work reports on it, and this is a change in technology. They certainly have much higher profit margins, as I explained in some of the slides, than other companies, because people want their goods, and they're producing these goods at competitive prices, but they have a price advantage, and they can price their products as they like rather than what the demand wants. The tech sector, to us, the whole sector is not yet expensive compared with, as I explained, the historical norms, because the earnings are coming through very strongly. The companies, they provide the key competitive advantage for major advanced economies. We, in our economies, as you know, nowadays finance can be moved anywhere around the world. So even a developing nation can, by the press of a button through their bank or direct, get and raise capital. Their staff and their people have wages that are far, far lower than ours, which are developed economies. And they can use the same computer control and other machines to produce goods. But our advantage is companies that are high in technology. And they're the ones that can provide us our advantage over developing worlds going forward. The other thing I mentioned already is that the earnings outlook is very strong for the global tech sector and is likely to continue and even possibly increase. As you saw that over 10 years, our technology fund has produced 20% a year. I think last month to August, it was higher at about 21% a year. And the 1-year return is close to 30%, which was much more than the previous years. Now, the technology fund, as you know, is the best performing international share fund on major surveys in Australia. And indeed, it was the #1 fund from FNZ Research in New Zealand 2 years running, till I think that research house shut down. So we have the best performing fund, and we think that our selection of the brain technologies is helping us. Now, the technology fund, as I mentioned in summary, has 3 underlying managers. So we have exposure to large cap, mid cap, and small cap technology companies. And some of these small cap, as I said, could have started in garages, have got capital with them, and about to leapfrog into the big stage. So we have exposure to them, and mainly in the biotech sector, we've got some small and mid cap, which we think have great potential to change the way health is managed around the world. Our focus for our fund is purely technology. It's pure technology, no hospitals and stuff. Brain technologies, biotech, robotics, artificial intelligence, and nanotechnology. That is the pathway to the future of the world, and we are actually proud to have developed this and can offer it to you in New Zealand and to your clients, and I'm sure that they will benefit from this investment. And I can tell you one thing more. We are not going to live on our laurels. We are going to work extremely hard, and our team will continue to work very hard that we can deliver for you and your clients. I think that's about it. I have a start. So I'm not sure how we can take questions, but I think there's still some time.
Afternoon, everyone. And Indy, I'm unsure from the question side of things, but just from our end, or from my end, I'd like to say firstly, thanks to Indy. Obviously, the investment case for the technology is certainly compelling for investors. When it comes to the question side of things, there will be follow-ups, but I think getting back to technology, the benefit of technology to society and those who invest in it effectively is certainly captivating. But yeah, just whilst we still have you, a bit of that administration, if I may, as per the registration details, we will provide you with some up-to-date information on the technology fund, so please look out for this. It would also include the contact details of our team, obviously myself, Jacob Abbott, as well as Indy Singh, Conrad, and Jay Singh, so that you can reach out to us when you need. Now, for example, should you have any further questions as per this webinar. On that note, once again, thank you for those who attended. We sincerely hope it was beneficial and look forward to following up with you in due course to obtain any feedback that you have and support any further information requests that you also may have. So thank you from my end and take care.
And thank you everyone from me as well. Jacob's right, we can answer whatever questions, just send them in. Dr. Wai Chen was on the webinar as well, and we're more than happy to answer questions. I just think that this system and the way the presentation is done is difficult to take questions straight away. So thank you again for attending.